The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick in the London studio. Arabile is live in Liverpool covering the Labour Party conference. These are your headlines today. Asian stocks hit a 2.5-year high as China releases a wave of stimulus, cutting the 7-day reverse repo and the RRR alongside measures aimed at shoring up the troubled property sector. Fed officials temper expectations for further jumbo-sized rate cuts as JP Morgan Chase CEO Jamie Dimon tells CNBC TV 18 exclusively there's still reason to be cautious.
The long-term optimist, short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
The Dow and the S&P 500 hitting fresh records as the Fed cut relief rally continues. We're going to discuss the US outlook with Goldman Sachs' CFO Dennis Coleman, 700 BST. And an unfriendly attack. German Chancellor Olaf Scholz hitting out at Unicredit's move to up its stake in Commerzbank to a potential 21%. We're going to hear from Commerzbank Supervisory Board member Stefan Wittmann later today.
UK Chancellor Rachel Reeves uses her Labour Party conference speech to defend the tough decisions on public finances, but says October's budget will deliver ambition, not austerity.
Stability paired with reform will forge the conditions for businesses to invest and for consumers to spend with confidence. Growth is the challenge, and investment is the solution.
I think a lot of investors around China have been walking through the desert for a long time. They think they see water. Turns out it's not an oasis, it's a mirage. Yesterday we had a move on the repo rate. The market thought this was underwhelming again, perhaps just a droplet of water when a fairly large amount of stimulus was required. And here we go today. Big announcement that was set up. The market is getting something that they've been looking for a while now.
I disagree entirely.
You don't think it's enough?
No, I don't. I think there was never a supply problem. Everybody out there knows that credit is cheap, that the financing is abundant, that property is cheap. The fact of the matter is you cannot make people buy something by making the financing cheaper if they are scared to go into the market, if they've had their fingers burned, and if the property market is still falling, despite experts wanting a plateauing of the property market, a plateauing so that land sales pick up, so that revenues pick up on a municipal basis, so that the coffers get refilled. The fact of the matter is the canny Chinese consumer, who is a very smart man and woman, they are still saving at over 40% because they had a near crisis recently. They've had an existential shock. This is all about supply. It's not about creating more demand. I'm sorry to say I see it as more of the same. I see the markets rallying strongly today. I don't know if the national team's involved as well, but the fact of the matter is this is more of the same, making it easier for people to buy if they want to. The problem is they just don't want to.
Well, perhaps it's a time-buying measure, and the reality is in recent weeks and months, the Chinese government has been losing the sentiment game. So every announcement has been so underwhelming. They're losing the animal spirits. And I think that's a problem if you look at the retail side as well, the lack of spending that's been taking place on some of those tech platforms, the nature, the loss of momentum, I think has become such a big issue. So let's just see whether today makes a difference as China's central bank unveiled a range of bigger than expected monetary stimulus and property support measures in a bid to boost the struggling economy. The PBOC announced a 50 basis point RRR cut and said it will cut the 7-day repo rate by 20 basis points to 1.5%. The bank also said interest rates on existing mortgages would be reduced by an average of 50 basis points. Asian equity markets welcomed the measures, with broader stocks rising to their highest in over 2.5 years. Chinese stocks and bonds also rallied. PBOC Governor Pan Gongsheng signalled the bank could cut reserve requirements further.
近期将下调存款。
In the near future, we will lower the reserve requirement ratio by 0.5 percentage points and provide long-term liquidity of approximately 1 trillion yuan, or $142 billion, to the financial market. Within this year, depending on the market liquidity situation, the RRR may be further lowered by 0.25 to 0.5 percentage points at an appropriate time.
A look at some of the big China property names, and you can see that they are in rally mode. 5.4% up for China residential land. That is a significant bounce also from the low point for Sunac. A near on 10% bounce there. Midea rallying, and Longfor Group also now on the front foot. Let's get to Sam for more. Sam, there's another feature that we haven't mentioned here, and that is a jumbo-sized rate cut from the Fed last week, perhaps allowing central banks that need to reduce their monetary policy setting the ability to do so now. Just walk us through some of the moves and where you think they might have some significance.
Morning to you, Karen and Steve. So the Fed's 50 was definitely seen as having made the PBOC's job a little bit easier. And that's why they surprised the market last Friday, although some in the market, you should say, that they didn't go with an LPR cut. But obviously they were waiting for this big press conference that they delivered today to show that they are taking a coordinated approach to trying to stimulate the economy. So what we've seen is sort of three parts to this, and that is what's been described as a tsunami of rate cuts. The RRR then plans to cut the MLF and then scope for the LPR to then subsequently be cut as well. Then, of course, we also got some of those measures for the property sector, the struggling housing market, by the way of some of the reductions to the existing mortgages. That's been something economists have been calling for a while. And then also with regards to the down payments. Then we also had some stimulus measures, or you could say just some support measures for the stock market as well, with further promoting M&A. And the thinking here is that that should help things out as far as liquidity is concerned for some of the tech companies. So all in all, it was a package. As far as what the market thinks of this, as you say, we've seen stocks rallying, and Steve raised the question whether this national team is at work here, because initially we saw a bit of a pop for Chinese equities, but then they had a bit of a think about it, and we actually saw a bit of a pullback off the session's high, and then they sort of surged into the lunch break. We're just coming out of that right now, and we're sitting up almost 2.5%, over 3% there for Shenzhen stocks. When we look at these rate cuts, and Steve brought this up before I heard your conversation, a lot of the analysts' thinking here is that it's not the cost of capital that's the constraint. It really is confidence, people feeling good about their long-term income expectations and their jobs. Don't forget, we've got youth unemployment at 19%. China now wants people to work longer. There are fewer jobs. There are constraints around this as well. So a lot of these Chinese citizens, their wealth is tied up in the housing market. The value of their investments have gone down, and this is their 401k, what they put into second homes. So we'll have to see how this filters through the bureaucracy over the coming weeks and months. For now, it's some short-term relief for the markets, but certainly as far as the analyst notes I'm seeing coming across the emails is that more needs to be done. I'll send things back to you.
Sam, we do appreciate the detail. Let's just peel away and take a look at the rest of the Asian markets and see how this confidence game has been played out across the region. You can see it is green across the boards, a bounce for Japanese stocks, Tokyo rallying close to 1%, Hong Kong very much in the green thanks to those big property stocks, 3.8+% bounce compared to the 2.3 that we're seeing on the China market itself, and over to the Kospi in the range, 0.75% almost. So we're being dragged high with the rest of the region. So confidence very much been sprinkled across these major boards. Let me take you to the US markets. And speaking of some of the euphoria, it really has still been coming through on those US markets on the back of those Fed moves last week. We again still see fresh records. The Dow, it may be a smaller range, but that was a fresh record that you saw in session. All-time intraday high, record level on the finish. Same story too for the S&P 500 on that close. 5,718 on the boards, another 0.25% plus to the upside. The Nasdaq, we're still some territory off the all-time high, about 3.7%, but it is really in range still. And you can see, despite record levels and green here, they are very much in a limited range. Energy, the big driver for the markets yesterday. I want to take you to Treasuries and how we approach, because there is a real split as to what the next point move could be from the central bank, whether it's 25 basis points or 50 basis point move. In the short end now, you can see we're still very close to that 3.6% mark on the 2-year. The 10-year, we're trading 3.76. To WTI Brent gold, we've been rallying around some of those record levels on gold prices. A lot of geopolitics in the backdrop, so the caution still very much being demonstrated in the precious metal space. I mentioned energy stocks, and of course, we saw some of that appetite in the stocks yesterday, and the basket itself. Today, WTI and Brent prices both up strongly, more than 1% to the upside. 71 on WTI, 74.63 on Brent. Geopolitics, these Israeli strikes on Hezbollah, closely watched for any widening of the conflict in the Middle East. Gold prices too on the front foot as a result. Opening calls, Europe in this context. We are chasing a bit more green this morning. Yesterday, modest tick high of 0.4% on the Stocks Europe 600. So indications are this morning we'll pick up some more green, Steve.
Thank you very much indeed. Right, Atlanta Fed President Raphael Bostic and his Minneapolis counterpart Neel Kashkari both backed the Fed's half-point move. Hang on, we knew that, didn't we? Anyway, there was only one dissenter. Anyway, Bostic said he may have erred on the side of a smaller cut, but said the bumper move will help bring rates closer to neutral as inflation and employment risks even out. He also warned against committing to large moves, citing uncertainty over the so-called neutral rate and concerns over the return of inflation. Kashkari also called for smaller moves ahead, saying he expected 2 quarter-point cuts this year unless the data changes dramatically. Speaking to this very channel, Kashkari said rising prices are no longer the key concern.
The risks have shifted. I look forward and I think, which risk am I more worried about right now? A surprising uptick in inflation or a surprising uptick in unemployment? It's the latter, at least it is for me. I think right now we still have a strong, healthy labor market, but I want to keep it a strong, healthy labor market. And a lot of the recent inflation data is coming in looking very positive that we're on our way back to 2%.
And JP, I don't know what that was. Was that the Gremlins? Was that the Matrix? That was the Matrix. That's what's really going on here. JP Morgan, he was doing so well. The technical team has done so well this morning. There were so many minor gremlins, but yeah, just wrong button, I guess. JP Morgan Chase CEO Jamie Dimon downplayed the Fed's bumper cut when he sat down for an exclusive interview with our sister channel in India, TV18.
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy. But we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can they be a further impetus?
Yeah. Again, so when you talk about rising, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID. So, 5% was probably needed to slow things down just a little bit. Yeah, underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, they're panicking to, maybe the economy gets stronger, maybe it's going to get weaker. And so they're trying to they're reacting to data they see today. And then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And even AI, in my view, right now it's all inflationary because we're all adding a lot of talent around data. It's not, the deflationary part may happen, but that may be several years down the road, yeah.
Coming up on the show, German Chancellor Olaf Scholz slams Unicredit's bid to become the biggest investor in Commerzbank, calling the move an unfriendly attack. We'll have more after the break. Plus, we'll be live from day 3 of the Labour Party conference as Chancellor Rachel Reeves vows no return to austerity. Arabile will have the latest from Liverpool. And Annetta is at the German corporate conference in Munich and will be joined exclusively by Goldman Sachs CFO Dennis Coleman. Don't miss that conversation at 7 BST.
The most important job any journalist can ever ask is why? Why? Why is someone saying something? Why do they believe something? It's like, plus all the other key questions as well. And that's what I'm asking about Olaf Scholz. Why? Why are you saying, German Chancellor Olaf Scholz, you're opposed to a Unicredit takeover on principle of Commerzbank, criticising Italian lender's move to buy more derivatives that could raise its stake in the German lender to around 21% as, quote, an unfriendly attack? Show me an attack that's friendly. It's an unfriendly attack rather than a friendly attack. Commerzbank shares bounced on the news that Unicredit was moving to increase its stake and seek ECB permission to own up to 29.9% of the German lender, before moving sharply lower as the German government expressed opposition to a takeover. Why, Germany? Why are you implicitly against a bank that is stunningly well run, basically making your second biggest bank better run? That's why I just want to know the question. And you don't believe me? Take a look at what the market's saying.
I'll have a go.
Well, no, let me finish off, because I'm actually halfway through my rant. I've got another 20 seconds on my rant. First point, the Unicredit trades at a massive premium in terms of price to book to Commerzbank as well. It trades nearly price to book of 1, whereas Commerzbank is only up at 0.6 because of the bid situation. It spent most of the last few years at 0.3 to 0.5, as you and I both well know. So is Commerzbank doing really, really well? So I took a look back at the return on tangible equity, something you and I pore over every time there's results. And the return on tangible equity, if all goes really, really well at Commerzbank this year, it's going to be 8%. 8% return on tangible equity. By the way, the US, habitually, the big banks there make mid-teen digits, by the way. So I looked at Unicredit, and you and I did this when the numbers came out earlier in the year as well. 20%. 20% return on equity over at Unicredit. So I asked Germany and Olaf Scholz again, what have you implicitly got wrong with this merger that would A, potentially make your bank more efficient, and B, create great synergies for the German assets that are already there for Hypo Vereinsbank as well, and for Unicredit and for Commerzbank as well, and potentially make you a lot more profitable, which would then be better for Germany. Can I make one tiny other little point that I may have made before as well? Germany is desperate for banking consolidation. There are 1,300 banks in Germany, which is, as you and I both said the other day, more than 3 times the number of French banks as well. Do we not need consolidation in Germany?
Yeah, here on consolidation, but let me just pick up on some well-reasoned points that I think someone from the German government may have made on a phone call to the FT yesterday, because there is a terrific piece and they are quite reasonable arguments. One is about the concentration of risk. And number one, that if you do see the cross-border merger, that about 30% of Germany's export finance could end up concentrated in this unit. But the reality is that some of those decisions may not be made in Germany. There are reassurances at this stage saying, look, we would have a team on the ground making those decisions, but the concern here is that it would be slower in terms of lending approvals, and risk management would also be outsourced across the board in Italy, which may slow down approval for what is the backbone of the economy, small and medium-sized businesses. The other point that the German government seemed to be making was that you may not see some of the clients stay with a Unicredit Commerzbank. The 25,000 clients may actually move somewhere else because they're concerned about who they're banking with. If that is the case, do you see a concentration of risk?
So to bank with a bank that has a return on tangible equity and a price to book at a significant discount to a better run bank?
I think it's about concentration of risk. And if we think about a recent example, SVB, where you had a concentration of risk, a whole heap of technology companies all lending with the same bank.
SVB was a regional bank that was poorly, had poor risk management internally and externally.
Yes, but
I think one of Europe's largest systemically important banks does not have better risk management.
But the reality is you have to somewhere to go. You need to have a bank to go to. And where is your go-to bank? Is it the rival bank, which is Deutsche? So I think that the market is concerned that you would see too many people stampeding in one direction, that you wouldn't have the strength that you've got in terms of lending. And let's face it, the German economy isn't that strong right now. So this is a genuine concern about those SMEs.
We had Deal Logic on last week.
Yes.
And they had those charts. And they had charts of M&A, fundraising, capital market raising, corporate relations, all kinds of pages of it. The American banks were wiping the floor with the European banks. Are we saying that those top 5, 6 American banks, Goldman's, Morgan Stanley, JP Morgan, Wells Fargo, Jefferies, Citi, are we saying they're not well-run banks? And we're saying they don't have strenuous risk management internally and externally by the Fed? Well, I think we're saying they are.
Credit Suisse, I mean, there have been recent examples in Europe where risk management has been a problem.
Absolutely. And that is why we're all utterly bemused at why the really well-run bank that is UBS, that has basically rescued the whole situation for the Swiss government, is now being penalised because they're too big.
Well, don't forget, if we're talking about people going to rival banks, and Deutsche Bank, that was a bank that only just got itself out of crisis. So there have been genuine concerns in the German banking system itself.
Karen. Risk management is the problem. Internal and external risk management is the problem. Size doesn't matter. You can be big, like with Lehman's. You can be smaller, like SVB, like Northern Rock. Poor risk management internally and externally. It doesn't matter if you're big. If you're big, in fact, I can make an argument. If you're big, you're going to have more scrutiny from the regulators. You might even be better run.
Size, I think, may not matter to you, but it may matter to the regulators, because if Commerzbank and Unicredit can't consolidate, where would that leave any rival Deutsche Bank Commerzbank tie-up?
We look in the mirror at Germany and see where a few of their problems at the moment, and that is perhaps getting the right kind of financing to the Mittelstand and to the big German companies and other companies. Sorry, Adam, we've got to move on. But yeah, that's like... Size isn't the issue, it's risk management and responsible risk management. If you're a bigger bank and you have more regulatory scrutiny, that's a good thing, yeah?
It's meant to be.
But I just used every example. Look at the titans of global finance. They ain't European. They ain't European because we restrained by size. We have no CMU. We have no banking union. It's an utter failure.
Well, you say bigger is better and better regulation, but the question, if you look through that,
if well regulated.
Exactly. So the problem with Switzerland is that there's still question marks whether the backdrop for regulation is correct, whether there's the right skill set and the regulators to monitor a much larger bank that's being created. So again, we go back over the same territory as to whether you have the right regulation in Europe.
We'll hear from the Commerzbank board member and senior Verdi trade union official Stefan Wittmann today. We'll bring you that towards the end of the show.
We've got to push on to politics at home as UK Chancellor Rachel Reeves says her October budget will deliver economic growth. Speaking at the Labour Party conference, Reeves said she wouldn't avoid tackling what she described as a £22 billion black hole left by the previous government, and that delivering stability would help boost investment.
Stability is the crucial foundation on which all of our ambitions will be built. The essential precondition for business to invest with confidence and for families to plan for the future. The Liz Truss experiment showed us that any plan for growth without stability leads to ruin. So we will make the choices necessary to secure our public finances and fix the foundations for lasting growth. Stability paired with reform will forge the conditions for businesses to invest and for consumers to spend with confidence. Growth is the challenge and investment is the solution.
Arabile joins us from Liverpool at the Labour Party conference. Arabile, you've been hearing a lot of words, no doubt. Tough, painful, but not austerity.
Yeah, so I mean, it's a big question. And I just want to go back to even the conversation you guys were having just around Commerzbank. And it really is tantamount to something that could even be happening here, right? That internal risk management is something that perhaps the Labour Party has also been dealing with, right? Because they've had to shy away from this economic policy front, from talking about all of this to all the risks and the factors that are affecting the party internally. And so one would have thought that this conference would have actually been their sort of going out party, right? Where they've said to themselves that they've won this election and now they're the party and they're incumbent now. They're the ones who get to lead the country as well. But things haven't necessarily worked out that way, right? So it's become one where they've had to kind of temper expectations in some way, deal with the fact that they've also had doom and gloom for quite a while as well now, delivering that message around the tough decisions that need to be made in order to deal with that £22 billion hole that they've put forward then as well. So key question marks were around what would Rachel Reeves then say then as Chancellor of the Exchequer, and what exactly would she deliver forward to her constituents, to the party, in order to give a clear message that they are actually moving forward. So there was a lot of smiling being done, but the message didn't necessarily change too much. There was still the sentiment around, yes, there won't be changes to income tax, national insurance tax, or even VAT, for example. But the key question mark is, if that is a key part of your income, then where exactly are you going to get this income from? Because you've also just said that growth is the challenge and investment is actually the solution. So how are you going to do that without the income? On the other side, though, there could be a crackdown on tax avoidance as well as tax evasion then, as she then put forward in her speech then yesterday. She also then didn't make note of how exactly she would deal with other parts of taxes, including things like raising CGT. And the reason why I bring that one up is because we have an investment summit coming up then on October the 14th, right? And once you get to that summit, business and the investment community will probably be asking questions around clarity on things like taxes, including the raising of CGT or inheritance taxes, for example. And if you haven't dealt with that, what does the investment community then begin to believe with regards to you then and the policies you have then put forward? So it's going to be a key question mark as to whether you're still serving the constituents that have been served for the longest time. However, Rachel Reeves doesn't seem to think so. This is what she had to say with regards to the changes and what they plan to put in the past from this parliament and this government.
Where active government is called for, this government will act. And conference, it is time that the Treasury moved on from just counting the costs of investment to recognising the benefits too. So we are calling time on the ideas of the past, calling time on the days when government stood back, left crucial sectors to fend for themselves and turned a blind eye to where things are made and who makes them. The era of trickle-down, trickle-out economics is over.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.